When dealing with capital gains, some of the key aspects that needs to be borne in mind at a general level needs to be discussed. The first one is that the intention of this article is not to create cases of double non-taxation. What I mean by this here is, let's say for example, the capital gains are exempt in the source state on the basis of a particular treaty. And the right to tax such capital gains is given exclusively to the state of residence. But in the state of residence, let's say there is capital gain is 0%. In such a case, what happens is, while state S gives up its right to tax capital gains, state R does not tax capital gains at all. So this gives rise to a situation where there is a double non-taxation of income. In such cases, suitable clauses can be added in the treaty to say that the exemption in the state of source will be available only if this income is suffering taxes in the state of residence. There may be different policies to compute capital gains, and one of these could be depreciation. So let's say there is a capital asset, a building, which is used by a company in the state of source. It bought it for $100 and over the years claimed depreciation on it to the extent of $50. Now, when this property is sold, let's say for $80, the capital gain that may arise in the state of source will be 80 minus 50, 30. But what if there is no policy in the state of residence to allow depreciation on such a capital asset? If that be the case, in the state of residence, the value may still be $100 only. So these different policies should be reconciled at the time of allowing a credit for foreign taxes paid. So let's say if the foreign company, because there is a capital gain of $30 in the state of source, has to give a credit for these, all these aspects needs to be borne in mind. Transfer from PE in the source state to another state. Now, for example, let's say this foreign company had a permanent establishment in the source state, and this PE has some capital asset. What if this PE transfers this capital asset to another PE of this company in another state? Generally, even this is something which is considered as a transfer, which is liable to capital gains tax. Reinvestment of capital gains exempt from tax. Now, this can happen when the domestic tax laws of the source state allow for exemption of capital gain. So even if capital gain arise, let's say here, but the law provides that if you invest this into another building, we will exempt this capital gain. In such a case, the tax actually paid in the source state might be 0. Now, how will the capital gain be calculated here? Might again become a question of debate. In such cases, the companies can either agree in the treaty itself as to how these cases will be dealt with. If not, then the domestic tax laws of the state R may apply to tax such capital gains. Thank you for watching our video on international tax. In case you want to subscribe to our full course, you can go to the link courses.sortingtax.com. If you are an Android user, you can download our application, and when you go to this link, you can purchase the course here. In case you're looking for a different currency of pricing, you can click on the link given in the description here and purchase the course. Thank you.